Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Welcome back to TFR for another edition of Investor Stories. On this segment, the experts talk about a startup that failed and the causes of that failure. Here's the segment called Post-Mortems. On today's special segment, we have Stephen McIntyre of Frontline Ventures. Stephen, can you tell us a story about a portfolio company that failed and why it failed?
Well, I'm only 4 years into my career in venture, so the failures are playing out as we speak. It's probably a little too early for me to talk about my ones. What I can see from Frontline's seed portfolio, which started before me, was although we generally wanted to focus on B2B, we made a few consumer investments, and I kind of realized quite quickly that we could get out of our depth there because just the amount of capital that was required to take these consumer companies to scale was sort of beyond the firepower that we had in a 50 million euro first seed fund. So, that was just a lesson in specialization that came pretty early.
On today's special segment, we have Gigi Levy Weiss of NFX. Gigi, can you tell us a story about a portfolio company that failed and why it failed?
Wow. So many of those. Give me a field. I invested over the years in literally hundreds of companies, so it's kind of tough for me. A games company that failed. A few years ago, I'm not going to say the names because I don't want to embarrass founders, but a few years ago came a founder that was an Israeli, incredibly talented and very, very, very kind of assertive and energetic founder. He came and gave me a pitch, and I decided to invest in him despite a few red flags. The first one was that he was a sole founder. And at the end of the day, we do invest in sole founders every once in a while. The statistic shows that sole founders succeed less than half the times of 2 or 3 founders. I think it kind of goes down again at 4 and above because not enough equity and too many chefs in the kitchen. But one founder is always tricky. It creates a huge mental load on the single founder, and I think that was one of the mistakes. The second thing was that he was really good on the artsy side, and I believe that he can learn the science side. And what ended up, he ended up creating a great game that looked really great and had everything, but he just couldn't. In a great game company, the iterations are all based on data. You don't just you start with your feeling, and your feeling goes with you all along. But the iterations are just based on data. And he was just continuing to iterate based on gut feeling. And that was it killed the company.
On today's special segment, we have Richard Kerby of Equal Ventures. Richard, can you tell us a story about a portfolio company that failed and why it failed?
Sure, yeah. So when I was working at Venrock, we invested in a company called Lux. It was an on-demand parking marketplace. So on the supply side, the company struck deals with parking garages to get supply to park vehicles. And they also had a 1099 workforce of valets that would take your vehicle and park on your behalf and return it to you when you needed it back. And the overall premise was that, in dense urban areas, there's generally a lack of supply in the exact area where everyone congregates, whether it's malls, commercial areas, whatever it might be. But if you just go, a mile or two further away from your destination, there's ample parking space. Like every city has the parking that the city needs. It's just not all in the area you want it to be in. And so, if you're going to the mall, no one's going to park 2 miles from the mall, then walk to the mall. You're just not going to do that. But if someone, a valet takes your car and drives it 2 miles away, it doesn't take a driver that much time to get there. And they're able to kind of take over that lack of supply or lack of demand in that neighboring neighborhood and fill that garage's supply. And so the business was actually working quite well, and each transaction was profitable. But the issue the business ran into is that they eventually had to turn their 1099 workforce into a W-2 workforce. And what that meant for them was you're now absorbing the cost of the idle time for your valets, where previously you were only incurring costs when the jobs were being completed, i.e., you're only paying out the valet for any job they're completing. Whereas in a W-2 model, if the valet is sitting there for 2 idle hours, you're paying them a salary because they were a W-2 employee for that time. And that really breaks the model for the business, and then ultimately led to it perishing from a unit economic perspective. That plus I think the ability or the inability, I should say, to fundraise in a market that became, I think, less convinced that this on-demand economy was ripe for more investment.
Why did they have to switch the 1099s over to W-2s where the Ubers and Instacarts of the world have not had?
Yeah, I think what we saw there was that the Ubers and Instacarts of the world, they started seeing their labor forces complain, sue them, and they were paying out their drivers, their fulfillment people who were giving them these class action lawsuits. But ultimately, our viewpoint was we are a way under-resourced company relative to Uber, Lyft, Instacart. And so we can only incur, class action lawsuits so often. And so at some point in time, the solution might be, hey, let's figure out a world in which this business works in a W-2 model. And ultimately, it didn't do so.
On today's special segment, we have Kane Hsieh of Root Ventures. Kane, can you tell us a story about a portfolio company that failed and why it failed?
Yeah, so actually one of our few bets in consumer hardware. Look, if I would try to distill the key learnings here is consumer products remain very difficult for a lot of reasons outside of the control of engineering. And if you're selling through retail, if you're selling through like a bunch of third-party retail channels, managing cash flow becomes really hard because they don't really always accurately report sales. And then suddenly, like at the end of the holiday season, you can find yourself sitting on like millions of dollars of, unsold inventory that they're sending back. And frankly, like it was just hard. Like any popular consumer product can be rapidly cloned. Sorry, not any, but many popular consumer products can be rapidly cloned, rapidly commodified. It's if I knew exactly why it failed, like of these reasons, it was like, here's the stack rank of why it failed. Like I would be a much more confident consumer hardware investor. The reality is like the reason I choose to look at that less is because I don't fully know what the key factors there were. I have a few guesses, but it's hard. And I think look, building and shipping stuff like this is hard enough when you're not dealing with all the kind of fickleness of consumers.
So is the postmortem there to just kind of avoid consumer going forward?
No, to be clear, not at all. Like there will be a lot of money made in consumer hardware. The point I'm specifically making...
I meant for you specifically.
Oh, for me is that I remain cautious or more cautious than usual when speaking to consumer hardware companies.
Interesting. Yeah, if you don't have a framework or, your own heuristics that seem to work and you have confidence in, then any category can be tough, right?
Yeah, that's true. That's really true. Like the hard part about talking about this failure is like I just don't believe I have distilled a high signal like framework or postmortem for it. And that's the most frustrating part of ventures. Like it'd be a lot easier if I knew with confidence every time why things went the way they went. Sometimes I have better guesses than others, but that's the challenge.
Sure. That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Also, if you'd like updates on new content from TFR, as well as the top 10 VC articles every week, go to fullratchet.net and sign up for the newsletter. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.